Hey, good evening, party people. It is I, Rags to Riches. I'm back here again with another episode of my show where I talk about things that are interesting to me. And today was an eventful day for the market. We had the FOMC meeting alongside CPI data releases. And for all those who are uninformed about the broader macroeconomic environment, why does the FOMC matter? Why does the CPI matter? Because it tells us about inflation. You know that thing that made eggs cost $10 in some places? That thing. Inflation supposedly, and actually confirmed today, is continuing to cool. The FOMC has decided not to cut interest rates, to hold rates flat, unlike the ECB, the Brazilian central bank, the Chinese central bank, and the Mexican central bank. Rate cuts are happening around the world, and yet the US is waiting, and I'm so upset because I want to buy a house, but that's a different story. On that note, I do want to make sure that anything discussed in this video is not investment or financial advice, as I am not, will not, and do not want to be your financial advisor. Please also note that recommendations for securities should be passed through a certified and registered broker-dealer at a wirehouse or your favorite reputable firm. You need to ensure that any choices that you make regarding your investment decisions, if you are a solo practitioner, aka a retail investor, or on the secret sidelines, a whale, are made in your best decisions and purview. On that note, let's get into the video. So, I have some Weeble stuff pulled up, but we're going to get into the articles here first. First and foremost, coming in from CNBC, inflation slows down in May with consumer prices up 3.3% from a year ago. Getting into the key points and then a bit of commentary. Consumer price index held flat in May, though it increased 3.3% from a year ago. Both numbers were 0.1 percentage points below market expectations. Excluding volatile food and energy prices, core CPI increased 0.2% on the month and 3.4% from a year ago, compared to respective estimates of 0.3% and 3.5%. Price increases were held in check by a 2% drop in the energy index and a just 0.01 increase in food. So as we can see, inflation continues to, at least on the more volatile measure of CPI, to decline and to slowly creep down to the Fed's longer-term target of 2%. There's an argument in the economic community that the Fed should likely change their target rate to 2 to 3% for inflation, just given some of the broader issues that are happening in the economy. To name a few. We printed 33% of US dollars just during the first year of the pandemic with the stimulus checks. We have ongoing supply chain issues in the commodities market, including precious metals, oil, agriculture, etc. We have growing U.S. companies and stocks due to the bolstering impact of AI. As companies leverage the resources of AI, while they may not need as many employees for operations, AI produces such a lift in productivity that there are inflationary trends. As companies can do more with less people, they'll be able to generate more profits, deploy that capital. More money chasing the same amount of goods creates price increases, at least in my perspective. There is an argument that AI in the longer term is going to be deflationary, which I do think is a possibility. To that same vein, the longer you can have productivity increases, the more AI becomes used and the less you need white-collar workers, because why do I want to go to attorney to draft up a legal agreement that can't even read, right? ChatGPT literally passed the bar on its first time, and that was version 3.0, not 4.0 that they have today. The thing literally codes Python. Why do we need human employees? It's kind of beyond me. But on that note, inflation is continuing to cool. Now, getting into the more important measure of inflation that the Federal Reserve uses, let's look at PCE. Coming in from USA Today from a man named James Powell, U.S. inflation is measured two ways. Here is how they compare. I wanted to share this article because I think PCE versus CPI is pretty important. So getting into CPI. To give you an idea, CPI, you can consider it as a measure of inflation. Here's how it works. You have a basket of goods that represents the average purchases made by households, such as expenditures for medical care, by employers to the government, common food items at the grocery store, shelter, food, etc. That can give economists and market participants a broad idea about where inflation is and where it is going to be going, just based on contemporary trends. Whereas the PCE report just to give you an idea here. Actually, I want to read out its article here. There we go. PCE is a measure of a broader swath of items that includes purchases made on behalf of the household, such as medical care and expenditures along those lines. The Fed likes to look at PCE as it gives a more accurate representation of what inflation is, and PCE does continue to cool alongside the broader CPI trend. So in terms of a US Fed rate cut, the question at this point is not if they are going to cut, it is a matter of when they are going to cut. And thankfully, we did have the FOMC conference today to give us some insights as to when that may take place. Going into the next article. Coming in from livemint.com, U.S. Fed meeting outcome live updates. Powell-led FOMC holds key rates steady at 5.25% to 5.5% for the 7th straight meeting. It's like waiting for Godot. I'm just waiting and waiting and waiting for a rate cut, and it just never comes because perhaps it never will. Just kidding, kind of. Reading a bit into the article, today they decided to keep their key benchmark interest rate unchanged. This came from a panel of the FOMC officials where they unanimously voted to hold the policy rate at the 2-decade high mark, and they only foresee one rate cut in 2024. We're actually going to get into a bit of context about that. They go over the CPI information, and then otherwise there wasn't much from the FOMC that really meant a lot. In short, Jerome Powell is going to look at the economic data because he is not a genie. He does not the future, and if he does not know the future, and if he did, I think he'd be trading stocks rather than messing with the interest rates of the U.S. economy and the global economy by proxy. What we do know is that as inflation continues to cool, as consumers spend less, as their wallets are pressured by higher prices and increasing economic instability in the labor market, then we should see less dollars chasing the same amount of goods, decreasing prices, hence deflationary pressures. That doesn't mean we're going to see lower prices, but if the longer term trend of inflation, which is not necessarily a bad thing, approaches 2% at a sustainable and reasonable target rate, that is when the Fed may be in a position to cut interest rates to accommodate some of the weaker sectors of the economy. And what are those? Tech and early stage companies are facing some challenges right now because they cannot get capital. Real estate is facing some major issues. The residential real estate market is essentially on a frozen hill. They cannot move. If you own a home, you can't sell a home, because if you sell your home, you need to buy a home. And if you buy a home, you have to downgrade because the price is a lot higher, and so is the interest rate. And you know what mom and dad with little Jimmy and little Sally are not going to do? Move into a smaller house because they need to move. They're going to stay put. And on the case of the sellers aren't able to buy at this time either because interest rates are so high. They can't even get into a starter home. Think about the average millennial, 26, 27, 35, still living at home perhaps, maybe just getting into their first job making over $70,000. The average American home price is $400,000 across the country. And when we get into higher cost of living states like New York, like California, increasingly like Miami, home prices are out of reach of the average American. So residential real estate is frozen. And then on the same vein, you have commercial real estate. The office sector is in shambles. Why is that? Because we had a pandemic and a bunch of white-collar workers that have been shuttling themselves to the office, taking hour-long commutes one way and then another hour-long commute to go back home, to be away from their family, to work a job which they don't actually like, they're just doing it for a paycheck, no longer necessarily need to be into the office full-time. Accordingly, long-term leases held by large corporates, banks, insurance companies, tech companies, etc., are essentially useless and a major expense for corporations because no one is in the office. So what are they doing? Some companies are canceling their leases. Some companies are defaulting on commercial real estate. Why? Because there's no need for it, and the risk for them doing so is essentially nil on the corporate level. Sure, they might take a credit hit. Sure, there may be some penalties and some covenants that have been broken, but compared to the longer-term loss of not actually utilizing a large piece of real estate that you have on your balance sheet, people are not happy. The economy is not in a healthy place right now. I'm not really sure what's going to make that clear to most people. I do not care if the stock market is going up. That doesn't mean everything is fine, because I think what people misinterpret is that this first rate cut doesn't mean that everything is hunky-dory, that we're going right back to the moon like we saw during the pandemic. That means that something is materially wrong with the economy, because if the Fed cuts, there is a risk that inflation could re-accelerate just like it did in the 1970s, I don't know if you guys know the name, but Paul Volcker was the man who rose the 30-year fixed mortgage rate to 18%. And that is what our friend Jerome Powell, J. Powell, is trying to avoid. Now, the reason why this FOMC meeting was pretty important is because they came out with a summary of economic projections. I do remain cognizant this is a YouTube video, and getting into really deep dive economic analysis may not be the most value add for a lot of your time. I do want to share at least the dot plot, though, as this gives at least the Fed's indication about where they want interest rates to be, where they think inflation is going to be into the longer term. So in terms of GDP, currently they have us at a 2.1 annualized growth rate for the broader economy, and they want to get back to 2% by 2026 and 1.8 in the longer term. Think 2030, 2040, etc., albeit it's so far out they can't project that with certainty. On the other hand, with unemployment finally hitting 4%, the Fed said we have not seen enough unemployment. We want it higher. They want next year unemployment to go up. So be sure you're working your butt off at your job, because the Fed literally wants you unemployed. And then on PCE, with a 2.6% reading in 2024 with a March projection of 2.4%, the Fed wants us to get to 2% PCE inflation by 2026 and 2% in the long run as well. What does this mean? Well, in short, the Fed has really limited options to slow down the economy and to make sure inflation doesn't rear its ugly head back up. The inflation genie was let out of the bottle because everyone wanted a stimulus check, because everyone lost their job during the pandemic. And yes, I understand that is hyperbole, but what does that mean? Well, in today's environment, how do you slow down spending? You lay people off. How do you lay people off? You raise up interest rates. You raise the cost to borrow. You make it harder for companies to expand, and companies that were founded on the backbone of debt will no longer, if they aren't profitable and actually doing something good for the broader economy, be able to grow. Hence, 4.2% unemployment in the long run. On the dot plot, scrolling down a little bit, this is where they believe they'd like the Fed funds rate to be in the longer term. By 2025, majority of participants think the Fed funds rate will be at 4%, so we're looking at, call it 100 basis points of cuts. By 2026, they want it at 3%, so then again, another 100 basis points of cuts. And then it looks like they want to keep the Fed funds rate at about 3% in the long term. Will they be able to pull this off? Obviously not. This is just a conglomeration of where they think interest rates could be in the longer term, but we do see concentrated efforts by FOMC participants to bring down the rate of the Fed funds rate over time to their longer term trend of 3%, a little bit above their ideal PCE or preferred measure of inflation. Getting into a little bit of market commentary. I manage this lady's portfolio, so that's like why I call it that. Equity markets. Dow Jones not doing too hot today. Yeah, go away. I don't care about your news. Elon Musk is doing great. Yep. S&P 500 broke out today from all-time high, so we had 82 bips of a gain on SPY, breaking out above my fib retracement level, so I do need to fix that. And I use fib retracement levels just to get a pulse on where potential price targets are going to be. As an example, if I wanted to use the fib retracement, if we were to head into a decline, my general price targets are going to be around the 50 and 61.8 level for retracement. To give you an indication about how that might actually work, going back to the previous all-time high, say I knew we were in an uptrend during the pandemic, and this was the peak, and I defined that as the peak after this breakdown. My 50 to 61.8 fib retracement level would have been about right here, and I would have started nibbling probably around this level here at the October lows. It's not necessarily a hard and fast guideline, but it can give you an indication about where you think prices should be. NASDAQ had a stellar day. They're also up 1.3% on the day, so tech stocks are roaring at the chance, the thought, the hope of lower interest rates. And then getting into fixed income, as you guys know, I am bullish on fixed income. We had a day. Muni bonds up 60%. Asset-backed securities up 17 bips. Agency bonds 27 bips. High yield bonds up 40 bips. Intermediate corporate bonds up 54 bips. Muni bonds up 47 bips. TIPS up 15%, surprising since they're tagged to inflation. Treasury bonds, 35 bips. Long-term bonds up 75 bips. And for fixed income, these are like crazy prints, guys. Like, this does not happen often for fixed income, especially just given the reversal that we're seeing. So on that note, I want to close out by saying none of this, again, is investment advice, but inflation does appear to be on its way down. I hope you guys enjoy the content. And as a secondary closing thought, I hope you guys find these videos interesting. I spend literally all my day helping out clients with their lending, investing, and banking needs. I figured this is information that is really useful to have for the average retail investor, not necessarily compiled in a easily digestible format by a lot of YouTubers. Of course, there are some that are out there that are really good, but if you guys want to really take your financial game up to the next level, these are things that you have to be aware of to better position yourself on a tactical allocation basis. If this is not something that you're interested in, the easy solution for most people, as Warren Buffett said, is to buy and hold an index fund. But for those who are trying to potentially beat the market over time, you need to have more information than the average trader. In my perspective, the market can be inefficient, illogical in the short term, and efficient in the long term. That's why I use a core and a satellite portfolio strategy. I have core equities in the form of long-term market ETFs concentrated in the US and then developed in emerging markets. They represent my long-term risk bucket. Whereas, on the other hand, I think there are thematic trends that are potentially dislocated as far as prices are today that I invest in actively for the purpose of short-term price appreciation, which then I rotate out of when the environment changes. And what is one good way to know if the environment changes? By keeping a pulse on the broader market and our friends at the FOMC. So I hope you guys have a great evening. I am going to be going to bed early tonight. As you saw from my last video, I was up late studying and working and trying to do the right thing, and I am so tired. So we'll talk another time, but not right now. Have a great night. Bye.